Hi, everyone, and welcome back to The Wealth Clock with Stephen Weinstock. I've been investing in real estate for over 20 years, started off in single family homes. I started doing multifamily properties, real estate syndications, and recently launched my own real estate investment fund. This podcast is brought to you by my company, We Capital, and the Goethals Capital Fund, where we buy properties in cash, we lock in deep discounts, and we eliminate the mortgage risk upfront for the first year, and then we refinance in order to scale. The show's not about me. It's about operators, founders, thought leaders, educators who are building real results in real time in the real estate industry. Today, I'm joined by David Auerbach, a 25-year REIT, R-E-I-T, REIT industry veteran, and the chief investment officer at Hoya Capital. Over his career, David has worn a lot of hats: institutional trading, portfolio management, sales, marketing, investor relations. He's seen every angle of the REIT world, and he's one of the best people who understand how these structures work. David, thank you very much for coming on.
Thanks, Stephen, for having me. It's great to be here.
Okay, David, where are you from, by the way?
You're talking to me from Dallas, Texas today.
Okay, are you born and raised there?
Born and raised. I live 5 minutes from the house I grew up in. Where I'm sitting right now, I'm about a block away from my high school that I went to growing up. So I haven't gotten very far in life.
Yeah, I'm about a half a mile away from where I grew up. I'm here in Brooklyn, New York. But yeah, I haven't made it too far either. What was your first job you had?
Are we talking about like when I was in high school or coming out of college?
First job when you were 18 plus.
18 plus, I guess, would be summer camp counselor in Eagle River, Wisconsin. But I started really as an intern to a financial advisor who was a hybrid CPA accountant / stockbroker. There's a couple of firms that focus on tax preparers, CPAs, that were doing investment management for their clients. And this particular gentleman actually happened to sublease space from my father's CPA practice many years ago, knew that I wanted to be on Wall Street as a kid, and basically gave me my foot in the door to get into the industry.
Got it. Talk to us about Hoya Capital.
Hoya Capital is the largest Seeking Alpha REIT research platform. We also cover other sectors like real estate, MLPs, closed-end funds, BDCs, et cetera. But it was started a decade ago by my partner who graduated from Georgetown University with his MBA, launched a research practice covering the 200 publicly traded REITs, home builders, and other real estate companies, built out what I call the baseball team, the bench of writers covering a lot of these other sectors, and then launched his first ETFs in 2018. Another fund was launched a couple years later. Today, Hoya has 2 ETFs listed on the New York Stock Exchange with about $130, $140 million under management. And like I said, we actively publish research daily, weekly, monthly, quarterly, annually across all of the different sectors and companies that make up the world of real estate investment trusts.
What type of assets is Hoya Capital invested in?
Hoya actually is a fund manager. It's also an advisor practice. So we own 99.9% of the publicly traded securities, the guys listed on the New York Stock Exchange, the NASDAQ, et cetera. We own the companies that own the hard assets. So as an example from where you're located, we would own SL Green, Boston Properties, or BXP, Vornado, Avalon Bay. The list goes on and on, but we own the publicly traded companies that own the hard assets. And this is why I'm so passionate about this, especially on the education side. Here's a great example. There's 2 publicly traded data center REITs that are out there called Digital Realty and Equinix. Why do I mention that? You and I are having a conversation on Zoom right now. Do you know how many conversations are happening on Zoom right at this moment in the United States, if not in the world? And the answer is a lot. And do you know who's earning the revenue off of those conversations? It's the data center guys, the Digitals and the Equinixes, which means shareholders are earning dividend income by you and I having this interview conversation today. We use these properties that are owned by REITs 24/7 and don't even think about it, and can earn dividend income by living our normal day-to-day lives. But yet we have CNBC on this screen over here. I've got Bloomberg on this screen over here, who focus on the headlines, the commercial real estate wall of debt that's coming due. REITs are interest rate sensitive. Oh, there's inflation. The list goes on. And yet our job is to peel back the layers of the onion to the company level and kind of highlight the misconception versus reality of what's really going on.
So you're obviously very passionate about the REIT space. How'd you get into the REIT space as opposed to traditional real estate investing?
It was by chance, actually. It goes back to my first job that I mentioned, working with that financial advisor. What led me to leaving that financial advisor was I had somebody reach out to me that had me take them to lunch to open an account, basically like my first account as a stockbroker. And I told my boss, and my boss was like, hey, that's awesome. You can't go have lunch with them. Why not? You're mine during market hours from 8 to 4, you're mine. You want to build a book of business? That's on your time, not on my time. And I said, networking is a 24-hour-a-day job. You don't set a time to go out and network. And by the way, you're my boss, which means any commission or revenue that I earn goes to you. So why wouldn't you want me to go have lunch with this client? And he basically said, my shop, my rules. And I go, that's the stupidest thing I've ever heard. P.S. I got fired the next day. So back in the day, when the newspaper used to publish a daily classified ads section or a job section, there was a classified ad. I'm not exaggerating. It was 2 lines, 1-inch font, got Series 763, call this number. I called the number, and it wound up being to be the junior trader on this REIT trading desk here in Dallas. So it was literally responding to a classified ad is how I got my start in the REIT industry.
Wow, that's quite a story. REIT investors love the dividends. Why is that? Why is dividends so popular with a certain class of investors? Although you'll have some investors who, could care less about dividends.
First of all, I've done a lot of these interviews, Stephen, and I've never been asked that question. So kudos to you, because that's exactly what I focus on every single day is the dividend side of the equation. Thank you. Let's unpack it. Your total return is comprised of 2 components: stock price appreciation and dividend income. I and my underlying constituents in every single company that trades on Wall Street has no control over what our stock prices do, period. But I can't control the dividend income that we generate in terms of how much we're paying out per share, how much we're covering our dividend, et cetera. But think big picture. REITs are dividend income compounding machines. The most well-known REIT, one of the most well-known REITs, is a company called Realty Income. For those that don't know, their ticker is the letter O. And their tagline, their motto, is the monthly dividend company. So Realty Income has paid hundreds, if not close to thousands of months of dividends in its history that they consistently raise year over year. Something I mentioned to anybody that wants to listen to me. One of the greatest gifts that you as a parent or a grandparent can do for your newborn child or grandchild is to go out on the first day that child is born, open up an UGMA account for that child, buy 1 share of Realty Income, 1 share of Agree Realty or Apple Lodging or another monthly paying dividend REIT that allows you to drip dividend reinvestment programs, redrip those dividends back into the stock. Why does that matter? That 1 share of stock that you buy for that child could appreciate to 25, 50 shares of stock by the time that child turns legal or when they cash in that account. The income builds on itself. Here's a very simplified example. Let's say stock is trading at $20 a share and the company pays out a $2 a share dividend per year. In 10 years, hypothetically, you've recouped the principal of that stock just through the dividend income that you earned. And oh, by the way, most likely that $2 a share is going to grow. The end investor, pick your favorite stock, forget REITs. The end investor, whether you buy NVIDIA, Microsoft, Apple, Intel, Simon Property Group, or something biopharma, whatever. You, the end investor, want that company to do 4 things at the end of the day: grow revenues, grow profits, grow the annual guidance, what you're going to earn per share every year, and grow the dividend. If you can do those 4 things, regardless of what's happening in the macro world, tariffs, interest rates, recession, whatever it is, if the company is able to do those 4 things, you would assume that by and large, all things are humming along and the company is on solid footing. And pretty much that's happening in the world of REITs. The world of REITs is like your graduating class in high school. Let's say there was 200 kids that graduated your class. You got the top 10%, the valedictorians, the salutatorians, the kids that went to Harvard and Yale, the companies that are in the S&P 500. You got the bottom 10%. The bullies, the troublemakers, the kids that were in detention, the kids that graduated D's, the REITs that are over-levered or can't cover their dividend. But you've got 180, 170 stocks and students that are in the middle of that curve that fly under the radar, that don't get the attention. And that's our job, is to focus on all of these companies in the middle, frankly, because that's what drives the car down the road. So you ask about dividends, why dividends are so important? Because we can control that income stream. We know where the dividend is going. That's pretty much relatively safe and guaranteed. And that dividend is based off of how much is that company earning, and then how much of that company is pushing that down to the bottom line to profits. Because that's the cool thing with REITs. 90%, if not all of the net income that they've earned after paying off the taxes and all the other stuff, that gets passed through to shareholders. That's the law. So you're basically earning income by this company doing its day-to-day, whether it's running self-storage properties, apartment properties, office buildings, whatever it is. They've got to pass out that profit to shareholders. But it's also why the management teams that run these companies own so much stock. They're on the front lines of the battle with the shareholders. So as that company does well and that dividend goes up, guess what? Management just got a nice little bonus in their pocket as well. So we all want to see that dividend machine continue to grow and thrive.
You've been in the REIT industry for quite some time. What's the biggest change you've seen in the REIT business since it started? And it started in the early 90s, am I correct?
It goes back to the 60s, really, when the REIT legislation was enacted. The real IPO push happened in the 90s, no doubt. And the simple answer is it's a night and day industry. It used to just be the big couple of sectors: apartments, shopping centers, offices, etc. Now there's close to 20 different subsectors that are out there. You've got things that are very well known and things that are not well known, like cannabis and billboards, and some of these timber is an example. So there's outlying sectors that you don't think of as REITs, but yet they are REITs. What's also changed? The world of investors. Back then, it used to be the REIT mafia is what they were called. You have the guys that got the REIT industry off the ground, the original institutional investors, and now you've got sovereign wealth funds, insurance plans, pension funds. It's because, again, of that safety of the dividend income side of the equation. The other thing that's changed, frankly, is the evolution of exchange-traded funds. Many years ago, it was just mutual funds. You were buying REIT mutual funds or owning the stocks outright. Now you've got ETFs and unit investment trusts, UITs, and closed-end funds, and all sorts of different avenues, and private vehicles. The way of private REITs has evolved dramatically versus what existed in the 90s. Look at what Blackstone and Starwood are doing, is to name 2 of the biggest sponsors that are out there. The platforms that Blackstone and Starwood have built, frankly, the market cap of those outweighs what was trading in the 90s. So I think we've seen, obviously, as commercial real estate has evolved and more buildings have gone up coast to coast and continue to evolve, that's why you see more players get involved in the industry. And then the magic 8-ball question is, what's the next cannabis sector idea out there for REITs? What's that next innovative idea? Is it solar? Is it something around AI? Is it the metaverse? Again, I don't know the answers to this. If I knew the answer to that, buddy, I'd be talking to you on my Gulfstream as I'm on the way to Fiji in my private resort. I don't know the answer to that. But if you had told me 25, 26 years ago that we would have 20 sectors and 2 other companies, I would have said you're crazy. And sure enough, that's where we stand today.
Are there any sectors that you are staying away from and any sectors that you are very bullish on?
We embrace all the sectors. So I would say that, no, we are not avoiding any sectors. We don't necessarily own the private REITs in our ETF because it's hard to mark that on a day-to-day basis. So we don't own that in our funds. But I would say that our job as fund managers is obviously multi-layered. But the real question is, where's the puck going? Where's that ball going? How is it approaching down the field? It's trying to figure out, where does the population migration trend shift to? As a good sector to follow is senior housing. There's a lot of precedents out there in the world of senior housing or healthcare REITs. When I talk healthcare REITs, we're talking senior housing, medical office buildings, hospitals, rehab, the list goes on and on. Forget the data center side of it or the Amazon effect on your cell phone and how you're interacting with REITs by ordering an Amazon package or whatever. Healthcare touches all of us at multiple points in our lives. You go to the doctor's office for a checkup. You got to go in for a surgery. You got to go get your teeth cleaned. You got to go to rehab. Healthcare touches all of us at many different points in our lives. It's a sector that continues to evolve. Thinking about senior housing today, frankly, there's not enough inventory out there for the next generation of tenants that are moving in, or for the further generations. And more importantly, for the generations that have grown accustomed to, as I joke, a certain lifestyle, modern amenities, fixtures, high tech, whatever it is. You're watching an industry that's evolving. And so senior housing is something to keep an eye on because it touches all of us in our lives, that we will be using various sectors of this. But then there's all the other sectors that we use every single day. A good example is net lease. When I talk about net lease, that means, frankly, going to your Starbucks and getting a cup of coffee, going to the gas station to get gas, going to the car wash, going to the out parcel, the sandwich shop at the mall, whatever it is. We use net lease properties every single day. Forget the grocery anchor shopping center, because a little bit different from where you sit versus where I sit. You got the corner bodegas. You don't really have strip centers du jour. I've got 2 back here. I got 2 down over. We got strip centers out the wazoo here in Dallas. And so the cool thing about our industry, to put a little bow on this, I always use this example, and I apologize if it's tired, but it just hits home. Do me a favor. How do you tell if NVIDIA is doing well? How do you observe NVIDIA in real time? You can't. You take Judson Huang's word for it when they report earnings, or you see him being interviewed by Jim Cramer on CNBC. How about Apple? How can you gauge how Apple is doing? Sure, they've got their investor day, their product launch. You see the line out the store when they have the new product launch, whatever. But you have to take management's word for it when earnings come out. All right. How do you examine REITs in real time? Well, that's simple. Brixmor is a shopping center REIT. They've got a property that's a mile down the road here that my wife and I go and shop at one of the grocery stores every other week or so. You can observe that shopping center 24 hours a day. How's the parking lot look? How full is the occupancy? Is the sign missing a light or something? How well kept up is that property? With our industry, you can observe your investments in real time, 24/7, because it's almost like eating. You eat with your eyes first before you actually consume the food. It's the same thing in the world of REITs and real estate. You observe the REITs and the properties with your eyes before you make that investment decision. I know that Brixmor property. Yeah, they're kicking ass over there. Did you know that Brixmor also owns this and this here? and 200 other properties of similar quality coast to coast. No, I had no idea. Light bulb goes up, education moment. Now you've got somebody interested on pull. And that's all what it's about, is we can look at these properties in real time and see what's doing well versus not doing well. Then, of course, it's peeling back the layers of the onion, look at the financial statements, the debt stack, the debt, to see really how well is that company doing. But at first glance, it's what's the actual physical real estate doing?
You're obviously very passionate about the REIT industry, and I hear it and I see it in this interview. You mentioned earlier that you produce newsletters, a daily, monthly, lots of content. Is that only for your clients? Is that open to the public? Is it a mixture of both?
It's both. I'm very approachable on social media. I run a daily newsletter called the Daily REIT Beat, so it's very easy to find. I publish the headlines regularly on LinkedIn, on Twitter, through our Hoya Capital audience. We do publish subscription-based research as well at hoyacapital.com, or you can find us on Seeking Alpha. So the answer is it depends, but we really try to level the playing field when it comes to news. That's my baby, is the Daily REIT Beat. That starts before anything else that I do. And again, it boils down to education. Let me break it down for you. As an example, we're talking at the end of August, and this particular morning, a sell-side firm downgraded a company called Health Peak Properties. The ticker is DOC, all right? Not going into the upgrade, downgrade, the rationale of the move, but here's why I mentioned this. The institutional investors knew about this downgrade at 7 a.m. Eastern this morning. They were able to prepare ahead of time because they know this report is out, I've got to read it. Here's what's going to happen to the stock. It's probably going to trade down because it's a downgrade. Okay, fine. The actual user of that properties that goes to Health Peak's properties, as I refer to, grandma and grandpa who live in the villages down in Florida, may never know that Health Peak was downgraded today, may not know why the stock is down if they happen to look at the account, or they look at their month-end statement, or their advisor may not know that this happened. So I try to level the playing field that grandma and grandpa find out that same story at the same time as the institutional investor does, and therefore everybody understands what's going on. It's not my job to say buy, sell, hold when it comes to the day-to-day headlines. Again, my partner on the research side, that's his job to tell you what's buy, sell, hold. But even then, even if I tell you, buddy, NVIDIA is a buy, you're going to be the one to determine at the end of the day, is NVIDIA a buy, sell, or a hold? And so I leave this piece of advice for anybody watching this today, tomorrow, next week, next month, next year, 10 years from now. Just because the advisor tells you to buy it, don't buy it. Do your own due diligence. Do your own valuation, your own metrics, read the reports, do your own analysis, because what makes NVIDIA a buy to me makes it a hold to you, makes it a sell to them. So no two investors are alike. And that's why I tell people, I don't care if you buy my funds or not. I want you to understand why you should be buying our funds or our sector. Once you understand the whys, at least of REITs and dividend income and all that stuff, then we can start unpacking why our funds might be a good option for what you're trying to accomplish. But I'm trying to get everybody more interested about the world of REITs, and here's the reason why. It's very plain simple. If REITs are interest rate sensitive and are tied to the 10-year treasury, etc., when the next Fed chairperson comes in the next few months, we already know that next Fed chairperson is going to take, frankly, let's call it an aggressive stance on interest rate policy. Therefore, if and when interest rates are cut, REITs and interest rate sensitive sectors are the direct beneficiaries of those cuts. Therefore, you want to get on board today for what's coming tomorrow.
Do you only invest in REITs or talk about REITs or research REITs based in the US or anywhere else in the world?
So we also cover the home builders because of our housing fund. So we do cover all of the home goods and furnishings and all the other stuff that make up the world of housing. Just I want to make sure we're clear on that. We are starting to tiptoe more and more international on the REITs and real estate side, looking at Canada, maybe some of the stuff that's in Asia that's out there. A lot of it responds to what our investors and audience are looking for. There's a lot of shops that cover Canada. Let's say Green Street just launched a big Canada platform here recently. But when you think about global investing and how US commercial real estate represents more than 70% of that pie, it all starts here domestically.
What do you do outside of real estate for fun or for any passion projects?
You might get a kick out of this. I've seen 240 Fish concerts.
Ooh.
And I'm on the track to try to get to 500 by the time that they're done touring, whenever that happens. I don't know if we'll get there, but in my spare time, I'm out crisscrossing the country trying to see as many Fish concerts as I possibly can.
Is Phil Lesh still involved, or is he?
That's great. He was in the Grateful Dead and he passed away earlier this year.
Oh, I mixed up the
Or
name.
last year.
So who was the lead singer? Who was the main guy in Fish, or the lead singer in Fish?
His name's Trey Anastasio.
Oh, okay. I wasn't into the Dead and I wasn't into Fish, but I had friends probably about 20 years ago, 25 years ago that were into it. And I guess I just mixed up the name. Okay. Here I thought I would wow you and instead be creepy. So you're seeing concerts all over the country, all over the world.
And farthest international, I've seen them as Mexico at this point. So I wouldn't say all over the world yet.
Got it. But I guess from Dallas to Mexico is not too far.
Correct.
All right, very nice. And so that means you're going to every concert available, or there's plenty more that you're missing.
There's definitely plenty that I'm missing, especially since the boss, also known as my wife, does have a say in my concert adventures of when I can and can't go. But we're always looking forward to that next show.
When did you start attending these concerts?
I started in April of 1996. I learned about them in the early 90s, though, when I was a teenager.
Got it. Oh wow. Okay. So I've seen some acts more than once. I've seen U2 3 times. I saw Red Hot Chili Peppers
back in the day.
I
didn't see him at Sphere. I heard U2 Sphere was a good show to see him at, though.
So I haven't seen them recently. I did see Red Hot Chili Peppers 3 times.
Okay.
And then I saw this band. It's based in Canada. It's more of a college band. It was called Our Lady Peace. And I've seen them, it could be over 10 times, but definitely a very good band. But
All right.
yeah, definitely something to check out. If you weren't in the REIT business, what would you be doing?
I would say at this point in my career, being this far down, now it might be education, like teaching college or high school finance, something like that. It's hard to go back in reverse and be like, all right, what would you want to do now? I always knew, again, as a child, that I wanted to be on Wall Street. My parents like to tell the story when I was 6, 7 years old. As kids are watching cartoons before school, I'm watching CNN Money and what's going on at the New York Stock Exchange. It's not that I own stocks or anything. I was just fascinated by the hustle and bustle of the activity on the floor. Looking at my father, again, as a CPA, had a daily subscription to the Wall Street Journal back in the day, and looking at stock tables, when stock tables used to be published in the paper every single day. You know, Berkshire Hathaway as a child, because their number in the stock table was so much larger than everybody else's. So we're seeing Boston Celtics or other publicly traded companies that I use or knew every single day. And that's what spurred me down this road. If I hadn't gone into REITs, it probably, again, was going to be a financial advisor, something related to Wall Street. Unfortunately, the floor business has changed. I wasn't going to move to, obviously, it would have been nice to move to New York. That's a whole separate story, where it would have been great to be in the pit, in the crowd, doing the hand motions, all the stuff in the exchange. That changed a long time, fortunately. But I remember my first trip in 2001, before 9/11, going to the floor of the New York Stock Exchange for the first time. And I'm not exaggerating. I literally had the chills walking out there for the first time, the hair standing up on my arm. I'll never forget that moment, because it was like, I hate to joke, it was Mecca. I was at Mecca, this place that I've looked up to as an establishment for so long. And here I am in the center of it and looking at the podium and all this stuff, just talking about, I'm not exaggerating, I gave the chills right now just thinking about it. So I always knew it was going to be something related to the exchange. And in fact, from that ringing, they give this out. I don't know if you can see the screen. They give out this coin at every bell ringing ceremony to anybody that rings the bell. And I look at this every single day as like a tiny symbolic moment of making it in Wall Street, of getting to celebrate that accomplishment.
For someone listening who wants to start exploring REITs, what's step one?
It's a good question. In fact, it varies depending on the motive. Some folks have the money side of the equation lined up, but they don't have the scale of the property side. Some folks have the properties lined up, but they don't have the money side of the equation.
So
Some people don't have the long-term vision.
let me rephrase the question. So you have somebody who is 25 years old, they have a few extra dollars every paycheck. They want to get into real estate. They want to invest. They don't have access to debt platforms and syndications. They don't know who to trust, who not to trust. There's something about being on the public markets that sort of helps with the process of making it easy, making it affordable, or some sort of trust factor is already in there just by the mere fact that they're publicly traded. What should he do with his extra few $100s every paycheck?
That is a great question. Kudos to you. And the answer is, frankly, it depends. So here's why I say that. There are publicly traded stocks that are trading from, frankly, pennies to Equinix right at this moment, which I believe is the most expensive on the stock side of it. Equinix at this moment is trading at $777 a share. So from pennies to $700 a share, you could buy stocks. My ETF, one of my ETFs is trading at $9.60, and you can own 100 REIT stocks through our one rack. You can buy publicly traded real estate REIT securities on the New York Stock Exchange, on the NASDAQ, on Robinhood, in E-Trade, etc. These are liquid investments. So you can get your foot in the door for a couple of bucks and own a very tiny fractional piece of tens, if not hundreds of thousands.
Okay. David, you're definitely one of the most passionate interviews I've done. Kudos to you using your words.
Thank you.
Thank you so much for joining me today. I'm going to put everything in the show notes, but tell our audience how they can reach out to you, phone number, email, whatever you want to put on. I'll put in the show notes. You can give them the alarm code to your house, whatever you feel you need.
Last 4 digits of my social, etc.
Exactly.
You can find me on LinkedIn, David Auerbach. I'm pretty easy to find. I'm on Twitter at Daily REIT Beat. As I mentioned, there's the Daily REIT Beat newsletter, thedailyreitbeat.com. Hoya Capital, Hoya Capital is our research website. You can find us on Seeking Alpha. You can find us at hoyacapital.com. But we're very easy to find with the amount of content that we publish.
Okay. David, again, thank you very much. I really enjoyed your perspective on REITs, dividends, and especially how REITs and the industry touches everyday lives, whether I'm shopping in a strip mall. Yes, we do have some anchored, maybe not here in the city, but I'm in New Jersey a lot. So I definitely know what you're talking about. Whether I'm at Starbucks, how these REITs really affect our daily life, whether I'm ordering from Amazon, and Prologis probably owns the warehouse where Amazon keeps its inventory.
You got the cell tower to place the order, the data center to process it, and the industrial warehouse to send it to your doorstep.
Okay, let's see if I have this right. I have American Tower is a cell tower REIT. We got Prologis will probably own or manage the Amazon warehouse. Did I get that right? Okay, what was the third one that you mentioned? Let's see if I get that.
Digital or Equinix, the data center.
Got it. Making all the O's and the ones back and forth. Got it. Okay. If you got value from this episode, make sure to follow The Wealth Clock with Stephen Weinstock. Or on Apple, Spotify. The video will be on YouTube. David, thank you very much. It was really fun to have you. You were fun to talk to. Until the next time, I'm Stephen Weinstock. Thank you for tuning in. David, thank you.
Thanks, Stephen.